Welcome back to the InvestTalk classroom. I'm Justin Klein.
And I'm Luke Guerrero.
And today we're going to talk about value traps. And this is one of my favorite topics because so many people are chasing yield and trying to get that 8, 9, 10, 12% yield in the markets. And sometimes that works out, but more often than not, it does not because they're investing in companies that look cheap, but the market is pricing them such that maybe their business going forward, their prospects of their business going forward are not that great. And these are the definition of value traps, that they look cheap, but in reality, their business is probably melting. Either it's being innovated away, right, by a competitor, or just simply the cycle of the business cycle is going to erode those profits. And we always talk about investing through the windshield. And oftentimes, investors are looking through the past and they're saying, oh, it earned X last year or last quarter. But in reality, that's not going to sustain. That happened a lot during COVID, right? Where businesses that sold individual products did very well because that's all people had money to do. They couldn't go out and spend on services like going out and dining. They just bought a bunch of stuff to use in their house. And now, in a lot of ways, those earnings are mean reverting. And the big question is, how do you avoid these value traps?
Yeah, and I think it's a common question that people call into the show at 888-99-CHART and ask about, right?
It's a good one. Yeah.
So they ask all the time about this company. I see it has a very attractive price to book. It has a very attractive enterprise value to EBITDA. And should I be buying it now? And you take a look at it, its fundamentals are poor. It's not making profits anymore. Its chart looks like a falling knife. And the answer is no, which is what we always talk about. It's important to have a holistic view, right? You shouldn't just be looking at one individual thing. Just because something has a low valuation relative to its assets, maybe there's a reason for it. Maybe it isn't a company that is going to be profitable. Maybe it isn't a company that has been going to continue to be successful like it was before.
Yeah, and you talked a little bit about those red flags, shall we say, right? And it looks cheap, but some red flags are it has a high dividend yield, and a lot of times that's because the market is expecting to cut that dividend completely or by a lot in the near future, or the chart, right? The chart looks terrible, and that's kind of the signal to you that, if this company is that great, maybe the chart should be acting a little bit better.
Yeah, and people chase dividend yield a lot, but if you think about it, like, what is a dividend? A dividend is essentially a company saying we don't have any positive NPV projects for which we can use this money.
NPV, or net present value.
Net present value. Sorry, I love my acronyms. Yeah. We don't have any positive net present value projects that we can use this money for. Therefore, we are returning it to investors. And in a sense, yes, a company that has a sustainable, within a range dividend yield, that's good. That's responsible corporate management. But when you get to a point you have an incredible high dividend yield, that is a worrying sign.
Yeah. And if they have that dividend, they've kept that dividend for a while. I've seen that a lot where companies consistently every year, their business is good and they have a dividend growth rate that's solid. And then suddenly they stop growing that dividend. And that could be because of some economic backdrop. That could be a reason. But if the balance sheet is becoming more leveraged, right, that's a clear indication that you're in a value trap, is that they have a ton of debt and that debt is growing. It means that their business is no longer supporting that dividend payment, right? They're having to take on debt in order to pay you out that 8, 9, 10% yield that on the screen looks really good. But as you cannot borrow infinitum, right?
Well, you can when money's free,
I guess,
but it no longer is.
Yeah,
right?
So it's even more difficult.
It's even more difficult to sustain that, to have to service that debt, which is why you should really be looking at like interest coverage, right? Yeah. What percentage of a company's profits? It's, before tax and interest profits, it's EBIT, if you will, another acronym, earnings before interest and taxes, is going to go to service the debt. And for companies where that is consistently increasing period to period to period, and they're not cutting the dividend, you got to think to yourself, what is going on here? And that's certainly something you should run away from as fast as you possibly can.
Yeah. And a good example of that I see a lot are the mortgage REITs. People look at, I'll just use the biggest one. I believe it's the biggest one, Annaly Capital. It's, a lot of people have talked about that and they call in, should I buy these mortgage REITs? And effectively these are banks, right? They're borrowing short, they're lending long in the mortgage market. And typically they're taking on a lot of leverage to do this, to take on that 10% yield plus. And if you look at what's happening within the business or within that structure, because I guess they're REITs, they're not businesses. They are issuing a bunch of shares. They're taking on more and more debt in order to pay out that dividend, and so they're just returning capital to shareholders. And so it's really important to understand whether or not that allocation of capital that the C-suite is deciding on makes sense and is helping sustain that dividend long term, and ideally grow it, right? Because the company, I think, that is not growing is probably dying. And so if there's a lack of growth in the business, balance sheet is becoming more and more levered, maybe they're issuing more and more shares in order to pay that dividend, eventually that's probably going to be cut. And that's not something that you want to be diving into. And so those are some of the red flags. Can you think of any more?
No, I think that covers it well. I think, like I said before, the most important thing to do is to look at fundamentally how a company is operating. Because just because something looks cheap doesn't mean it is cheap. Turns out it could be more expensive than it should be, and it could be getting cheaper real soon.
I love that. Great summation right there. Appreciate you all tuning in. If you want to learn more about value traps and how to spot good values, head over to investtalk.com and like and subscribe, and give our listener line a call at 888-99-CHART.